Hello everybody. Happy Tuesday. I hope everybody had a great extended weekend. Well, hopefully a better weekend than the market did. But we are here and we are ready to talk because I have lots of great information for you all today, mainly around the economic cycle, how different sectors will perform better and worse in certain markets, how besides the economic cycle, their prices are affected by other market indicators, as well as how you can try and use this information, as well as other pieces of information, to inform your decisions on where you want to put your money, when, and how. So hello everyone, let me just quickly go through the chat. Eddie, Mari, Consuelo, Adriana, Juan, Francia, Dinora, Kike, Delia, Mayra. Hope everyone's doing well. Hopefully everyone is staying hydrated. It has been a very hot week here in LA. It got up to 121 degrees on Sunday, and we've made it out of the heat wave, but not out of the heat just yet. We still got our fair share of heat yet to come, but you know, it is what it is. So, how is everybody doing today? Is the volume good? Everyone can hear me all right? Awesome. Then again, we'll just wait 2 or 3 more minutes and we'll get started. Hello, Andrew. Awesome. Very happy to hear it, everyone. Okay, I say it's about time we got started. Will I be having another discussion on the economic cycle today? Yes, I will. So, without any further ado, let's go to the topic for today's presentation and conversation, which is cyclicality. It's the idea that what we see in the market and what goes on, not just in our day to day, not our season to season, but our year to year, is not random. It's not something we can't predict, but it's also not certain. So what I want to talk to you all about today is the idea of the economic or the business cycle. What it is, how you can recognize it, and what it tells you when it comes to how you invest, where you invest, and when you invest. So without any further ado, let us get started. Before I go anywhere, I have to say this, that everything I'm going to share with you is textbook definitions. It is an idea that this is what we can expect to happen in a perfect market where nothing else in the world is going on, nothing else affects the market besides the market itself. Sadly, if it was that easy, the textbook would be the one making millions and we wouldn't even have to be working. But there are other things that happen in the market that will affect how the stocks do, and by proxy, how the market and sectors do. So everything I'm going to share with you right now is all from the very economic standpoint of what these different cycles are, and take all of it with a grain of salt, because what is going on in the world will be almost as important, if not more important, than where we are in the economic cycle. Changes in the economic cycle happen for a reason, and those reasons the textbook cannot define, I cannot define. So we can only do our best to figure out with the information we have what is going on. So with that being said, let us get started. So the topic for today is cyclicality, or the economic cycle. So what is the economic cycle? That's probably a good place to start. The economic cycle is sometimes called the business cycle, but it refers to this idea that economies tend to grow over time. They can go up and they can go down over the course of a year or 2 years, but on the whole, markets tend to go up. The economy tends to go up. But this growth is not a straight line. It's not some just straight escalator up to the top. There are points where it grows a lot faster, and then there's points where it might not grow at all. It maybe actually would go down slightly. So we define it in this kind of cycle, or this kind of up and down wave pattern, where we have periods of growth, which then lead to kind of a tipping point, and then it dips into stagnation or into recession before going back to a trough or the bottom and then taking off again. Or, as you've probably heard it defined in some different contexts, such as the dot-com bubble of 2000, the real estate bubble of 2008, all of these kind of major economic shifts are called bubbles, which occurs from an imbalance or kind of a teeter-totter of supply and demand, where if one hits the ground too hard, the other one kind of gets flung up in the air and you're starting to look to figure out where the ground is. So when the bubble breaks, that is when the market begins to correct. And before it can bounce back up, it's got to hit rock bottom first. So how do we measure this cycle? How do we know where we are, where it is, how long it lasts? Well, unlike a season, which is January to March, April to June, July, so on and so forth, economic cycles are not 1 year. Economic cycles happen much, much longer than just a year, where some can be as short as 18 months, others can be as long as 10 years, or in the case of, I believe Japan has one of the longest, where Japan had an economic growth pattern where it went from expansion to expansion of 23 years. So these patterns can happen over a very, very long period of time. And as a result, we can expect to see the growth be as slow as the market that it's following. So the economic cycle is measured by 4 major points, or 4 major periods. We have the period of, I apologize, I got ahead of myself. We define this cycle by looking at the market. But we can't just say, market, how are you doing today? Oh, it's a bad day. I got some bad news, or I got laid off of work. No, sadly, the market we can't sit down and have a nice conversation with. So we need to have things that we can look at in the market. These are GDP, which is the gross domestic production, or how much money worth of stuff did the US produce this year? That is the GDP, or gross domestic production. We can also look at the interest rates. We expect interest rates to give us a good idea of, are banks or financial institutions optimistic? Are they starting to try and pinch pennies and get a little bit more conservative? And then one of the most obvious is going to be employment. Employment is how many people are actually working, how many people are looking for work, how many people can't work, how many people are working, or how many people are trying to find something new. And all of this serves one single purpose: supply and demand, or supply and the availability of stuff to buy, and the consumer's ability to buy said stuff. So you would expect, if employment is high, that means I'm making a lot of money. The entire economy is making a lot of money, which means I have more money to spend. But when everyone has a lot of money to spend, the price of things starts to go up. Inflation starts to go up. Interest rates start to go down. And that's where we start to see these economic changes emerge. So let's talk about these different steps in the economic cycle. There's 4 major steps of the economic cycle. These are expansion, which is the market starts to go up and starts to get a little closer to flattening out. Peak, which is where the market hits the top and is starting to kind of turn over and go down the opposite direction. Contraction, which is a rapid drop, think your roller coaster drop. And then trough, where it hits bottom and starts bouncing back up. And different markets or sectors will perform better or worse during different sections or stages of this cycle. And also, we can't say that if we have an economic cycle of, say, 2 years, that the expansion is 6 months, peak is 6 months, contraction is 6 months, trough is 6 months. Different stages will happen faster or slower than others. Typically, you would expect for contraction and trough to be the shortest part of that cycle, kind of like you would a roller coaster. You have this very big slope as the roller coaster is going up. Everyone puts their hands up in the air and the roller coaster jumps straight down. Very similar to how many economic cycles occur. There's a slow incline, and then when that bubble bursts, it's straight down to the bottom, and then a slow recovery or even a quick recovery back up into that slow incline back towards peak and expansion. So the other thing to consider, though, is this is the economy we're talking about here. I want to show a difference where there is the economy, which is driven by the market, but there is also the market, which tends to forecast. Investors don't want to invest because something was good. They want to invest because what they're investing in will be good. So the investors, and as a result, the market, tends to precede the economic cycle, where the market will start to show signs of recovery sooner than the economy would, just as investors will start to jump ship far before the economy shows signs of doing so. To highlight this, and again, before I show this graphic, I've got to say, there's no set timeline. This is a image that is to simply show how the economic and market cycles overlap. But here it is. We can see that there is the recession and recovery cycle, which is our economic cycle, that happens at the same time, but happens after the market cycle, where we would have our bull market, which is our expansion, market top, which is our peak, bear market, which is our regression or our recession, and then our market bottom, which is the trough. And different sectors will perform better or worse during these different points in the market. Now, it's not simply like you flip a switch and suddenly these sectors become way better than others. Everything happens slowly and over time. So I want to look at that together. I want to first highlight what these different points are. What can we expect to see? What sectors would we expect to do well early into that stage, do well in the middle, and then be indicators that we're moving out of that cycle stage? So let's first start with our recovery or our expansion stage. This is the market's hit bottom and it's starting to go back up. This is the major growth stage of the market and, by result, the economy. Inflation is going down. Employment is starting to go back up, which means while more people are employed, spending begins to go up and prices begin to go up as well. In this market, it tends to be a buyer's market. Buyers now have a lot, well, not a lot more, but a little bit more supply of funds. They have a little bit extra spending cash, and they want to start investing it. They can start splurging a little bit, buy that new car because the interest rates are really low for buying a car, buy that new house because housing rates are low, or the ability to find loans is very, very good. This is the point where we start to see sectors such as discretionary and technology doing very well, where technology would be an early indicator of that early recovery stage. Discretionary shows that its spending has increased, buyers are starting to buy again, and communications is kind of our confirmation that we see moving out of early recovery and into our late recovery or peak stage. Our full recovery or our late recovery peak stage is the economic high point. This is where the bubble is starting to get blown a little bit bigger. Our inflation is beginning to rise because a lot more people have money to buy, which means supply has kind of stayed the same. Demand has gone up, so the prices, by result, have gone up as well. Spending begins to stagnate because it's not like you're suddenly going to get the third raise this year, but it means that your spending is going to be about the same that it was in that early recovery stage. But what will change is that the supply is going to start struggling to meet the demands of the market. And this is where that imbalance starts to occur, where we have this battle between the amount of supply that there is, meanwhile, all these buyers trying to rush to go buy it. In stages like this, we would expect for kind of our materials and our stuff sectors to do very, very well. This is where we would expect materials to do well because the ability to buy more inventory has gone up. Industrials, as a result of that, will go up as well. And energy will follow suit. Energy is going to be kind of that last holdout of this is the top. This is where we're starting to go down, and the roller coaster is beginning to show the bottom is somewhere in sight. Or rather, the way down is starting to become apparent. So we've gotten to the top of our roller coaster, everyone's put their hands up in the air, and now it's time for an early recession, or our contraction phase. This is where the demand lowers, the bubble bursts, and with it, spending goes down, which means with less spending, companies can't afford to keep as much labor or pay as much, so they're going to start laying people off. Because companies are no longer able to produce as much because they don't have as many employees, or they can't buy as much inventory because they don't have as much cash, their production goes down as well. This is where we'll see inflation continue to rise, and this is where the stock market will begin to slip. You'll start to see the stock market showing signs of panic and investors starting to try and sell off their very kind of bullish investments. This is where the market begins to turn very bearish and spending gets much more defensive. You start not thinking about buying that new car, but you start thinking about saving. You start thinking about putting some money away just in case for that rainy day. And in this, we would expect for very defensive sectors to do well, mainly staples and healthcare. Utilities is in there with a little star next to it because utilities is a sector that, while it doesn't perform very well in a early recession, does perform well in the mid-recession as we hit bottom and start to bounce back up. Utilities tends to be one of the earlier sectors to show signs of that increase in momentum. Then the last stage is our trough. We've hit rock bottom and now we're starting to go back up. Typically, this is the shortest part of the cycle where we would expect for things to go down quickly, hit bottom quickly, and then as investors start to realize, hey, now's an opportunity, this is where our investors start to get back in, buying starts to increase again, and inflation hits its maximum point. And the market begins to favor our demand instead of our supply once again. In this point, utilities would be our main indicator of moving into that late recession. Financials will start to do very well. And our indicator that we're moving back out of our recession and into our growth would be the technology sector. That's usually one of the first sectors to show signs of improvement when the economy is showing signs of improvement as well. Now remember, all of this is in a perfect world, and as I like to say, in a vacuum. There's nothing else in the world going on. It is the economy and the economy alone. Man, I wish it were that easy, but sadly it's not. All of this example that I provided to you right now is in a perfect world. The economic cycle that I've shown and the textbook definition of it assumes that nothing else is going on. There is no other effects in the market. There is no politics. There is no healthcare crisis. There is no insert global conflict here. This is only the economy. But sadly, we're not in a perfect world. But try telling that to investors. Investors, they don't care that we're not in a perfect world. They don't care about Democrat, Republican. They don't care. They only think in one color, green. They want to make money. And to do that, investors will try and predict what sectors will be hot or will be doing well in the coming months. That's why the market tends to precede or kind of come a little bit before the economy, is that investors are the ones that will say, hey, I think that this is going to happen. So usually it does. Where if you say, my leg feels funny, I think I have a little tingle on my baby toe. Suddenly your toe will start to tingle. Same idea happens here. But there's an investment strategy that all of this centers around. And it's called, and this should be very familiar to you because all of you are kind of investors into Sectors Made Simple. I'll put it that way. Sector rotation. It's the idea that you can buy a sector, hold on to that sector as it's riding up, and then as it starts to lose momentum, you jump ship or you reallocate some of those funds into another sector that you now think will be doing well in the coming months. This is why investing in sectors tends to be a little bit longer term of a strategy. You're not looking to buy a sector and then sell it tomorrow. No, you're buying it because it's something that the economic cycle is showing signs of growth for, and you want to be along for the ride. But as it starts to lose steam, you know that other sectors will take its place. There's always a bull market somewhere. It may not be in real estate today, it may be in financials. Tomorrow it may be in utility, or not tomorrow. 6 months from now it may be in utilities. 6 months from now it could be in energy. And that's the point of sector rotation, is figuring out this cycle. Understanding what sectors do well in good markets and what sectors do well in bad markets. So we know where our buying opportunities are and how much risk there is with them. So let's talk about sector rotation in the real world. I don't want to talk about it in our perfect world where the economic cycle is great. I want to talk about it in the real world. The economic cycle tries to predict what sectors will do well. It tries to anticipate the market. But different sectors will do well in different types of markets. Not just in the economic cycle, but in how defensive that sector is. Or put another way, the more defensive of a sector, or the more defensive a sector is, the more resistant it is to change. Where, think of it like you're building a house. You have your big bad wolf who wants to blow the house down. If your house is built out of stone, that's a very, very strong house that's not going to be blown over by the wind. But if you go to sell that house, it's probably not going to be worth very much, but you know that it's always going to be standing. How about a house made out of glass? A house made out of glass, it's beautiful, it's gorgeous, it's a work of art. Put it in LACMA for all I care. But if you throw a rock at it, that glass is going to shatter. So it may be worth a lot. It may be something that performs really well when everything else is going great. But the minute there's a light breeze and a rock gets right against the glass, everything shatters and suddenly there goes all your value. So that is the idea of a defensive or a cyclical sector, is how much does the price of that sector or how much of the performance of that sector relies on the economic cycle. Let's talk about that. Our defensive sectors are sectors that will tend to perform well, even in bad markets. They might not be our leaders, they might not be the ones that you make your profit and you buy your house in Tahiti off of, but they're always there and they'll always do well. These defensive sectors include staples, healthcare, and utilities, where these are some of our best performing sectors when the market is in its recession or its trough stage. Or, to put it another way, when the market gets conservative, our defensive investments will be the ones that will be performing the best. They're the least likely to be affected or to have their price change because of what's going on. So these are our brick houses. They don't care if there's a hurricane, they don't care if there's wind, they will stand strong. But they're hard to move. So that is defensive. Between defensive and cyclical, or our very kind of optimistic sectors, we have, as I like to call them, middle of the pack sectors. They're not anything super defensive. They're not anything super reliant on the economy. They are very much middle of the pack, where some of these sectors will perform well when the market is improving. Some of them will perform well when the market is on its way down. But all in all, these are the sectors that will tend to be much more reliant on what's happening in the world or what's happening in that sector, not so much what's happening in the economy. Sure, they'll be affected where if the economy goes just tanks, some of these sectors may be dragged down a little bit as well, but you're not going to lose your shirt, the dog, and the house in the process because it went down. These sectors will include communications, energy, industrials, and technology. Lastly are our super sensitive or our cyclical sectors. These are sectors that will be very, very heavily influenced by changes in the economic cycle. When things start getting better, these sectors do great. When things start to turn, these sectors tank. These are our glass houses. And these sectors include materials, discretionary, financials, and real estate, kind of real estate-ish. And the reason I say that is real estate's a tricky one, because real estate is not just a sector. It's a market cycle in of itself. Because, for example, in a recession, people are not going to be going out and buying nice houses. Unfortunately, some people may be losing their houses. So they're going to be looking elsewhere for cheaper forms of housing. So apartments, residential housing units will go up. So the real estate market is not just one sector, but it's an entire cycle where you would expect to see in a down market, in building stop. People are not going to be building new houses, but people are going to be buying conservative houses. People are going to be buying their apartments or trying to make sure that they can pay for what they have. When the market begins to recover, that's when investors will start, or people that have money put aside will start to buy houses. The market is a great opportunity. Interest rates are low. There's never been a better market to buy a house. You've heard that happen a few times over. That is when investors will start to buy houses. As more money flows into the real estate market, suddenly real estate companies have more ability to build property. There's more demand for said property. So with that, buyers buy in. Now the suppliers need to create more supply. So they begin building. That increases their demand for basic materials, and that increases their supply. Where as they move towards a peak of the real estate stage, there is now enough houses to meet what people are trying to buy. But that's not going to stop the real estate companies from wanting to make more money. That's not going to stop the banks from wanting to sell more real estate or housing loans. So they're going to continue offering better and better deals. But what happens when those deals are too good and they begin offering those deals to people that can't pay? That's what happened in 2008. Banks were offering interest rates that were stupidly low on loans that were far too risky that they should have had no business actually offering. And as people began to default or couldn't pay off those mortgages, these banks got stuck with a bunch of houses that they couldn't sell because the market began to turn, and with it, the real estate market crashed. So we see this same cycle of slow growth, peak, crash, and recovery. And this, while it sometimes will tie into the economic cycle, is a cycle unto itself. So that's why I don't just put this in one category. I put this in the super sensitive because it is. It's a very, very sensitive market. It relies on buyers having buying power, on financial institutions having the ability to offer mortgages, but it also relies on the supply of our commercial or our housing companies to offer houses. So it's tricky, but also interesting. There are things that are called REITs, real estate investment trusts, that are almost like ETFs, where instead of investing into a single company that does, say, commercial real estate, you can buy an entire diversified portfolio of commercial real estate companies. Those would perform well when companies have a lot of money and they're looking to buy new offices. But what if the economy is bad? What if people are selling their homes and buying apartments? Well, there's an REIT for that too. There will be REITs for apartment housing, for companies that specialize in building apartment complexes. So that's a whole little world in of itself, and I've already talked enough about it today, but it's a topic I could cover in an entire class unto itself. Violetta's asking a great question. Do we need to wait for the market to be in a bullish state to invest in defensive sectors? So no, funny enough, the defensive sectors will oftentimes be some of the better sectors in a slower or a worse economy compared to these other companies, or compared to some of these sectors you see right now. The sectors you see on the screen right now are our glass houses. They do well when everything else is doing really well. Our defensive sectors will be sectors that perform good. They usually do good. But when the market tanks, they won't be dragged down as hard as other sectors may. You would see maybe that consumer discretionary, when the market is turning towards a recession, consumer discretionary may be hit very, very hard. Staples is not going to be hit as hard. Things like that, where our defensive sectors, while they may, again, it's hard to say because they are more stable, but more stable doesn't mean they're still going up. In a bad market, everything can still be going down. So it doesn't matter if you're in the best sector if all sectors are not doing well. Because there's something to be said for, there's a time to invest, but there's also a time to hold cash, where not just different sectors perform better or worse during different markets, but different types of investments perform better or worse in different types of markets. If that's something you're interested in, please let me know. I can do a class on that, where certain markets will offer an opportunity for things such as bonds, things such as holding cash, commodities. All of these different types of investments that aren't just stocks become very enticing options. So right now, sadly I cannot tell you if it's a good time to hold cash or not. I can show you what I see, but that's a decision, sadly, you would have to make. But I can definitely talk about that in the future if people are interested to learn more about not just how sectors will change over different parts of the economic cycle, but how the investment classes or the type of investment that you look into will change as well. But there's one last thing that I want to talk about today, and it is the topic of quite a few of our newsletters recently, and I want to take a bigger look at it today. Volatility. I've talked a little bit about volatility and how we measure it, but I want to just start from the beginning so everyone's on the same page here. The cycle that I've shown so far is in a vacuum. It's in our perfect world where nothing else is going on, but that's never true. There's always other things going on in the market, and the market never really agrees on one price. So just because you see Tesla's price is $550, that doesn't mean that everyone is sitting out there trying to buy and sell their shares at $550. Investors may be trying to buy at $545 and sellers are trying to sell at $555. But what happens if it's not that simple? What happens if the buyers are trying to buy at 500 and sellers are trying to sell at 600? That's where volatility comes in. Where volatility is an indicator of very large, rapid changes in the stock market, where buyers and sellers have this huge gap between what they're trying to buy for and what they're trying to sell for. And in that will come large changes in stock price or even market price over a single day or week period. And this can happen mainly in the short term, where it will cause massive shifts in short-term performance, which is what we're seeing in the matrix right now. So I'll just hint at that before I finish talking about VIX. Once I finish that, then we'll go talk about what this looks like and look at it in real life. So volatility is something that we can measure in many ways, where we can measure how a stock changes compared to the market in something that's called beta, but we can also measure the volatility of the market itself. And one of the main indicators of this is a ticker symbol called VIX. VIX is maintained by a group called CBOE, and it's a measure of how volatile the S&P 500 is, where it uses real-time information where it says, all right, buyers, what are you buying for? All the buyers scream out their numbers. All right, sellers, what are you selling for? All the sellers scream out their numbers. Okay, how much of a difference is there between the two? That will be our indication of volatility. And it's represented by a number. If you're interested in the number, I recommend you go to CBOE's website where they show the actual formula that they use for it. But I'm just going to summarize it in that we want to see something, or we want to see a VIX number of below 15. A VIX of below 15 is considered to be a stable market. Well, let's go take a look at where we are in all of this, because it's sadly not so straightforward and not so simple. So I'm going to go here to Finance Yahoo and look up the ticker symbol little caret VIX. And I'm going to set our date range to this year. We see that we started off this year, if you look here at the open, high, low, and close, you can see that we started off the year around 12 to 13. Things heated up a little bit, and then one or two things happened in the world in March that led to some changes in, volatility got up to about 83. That was the highest point it reached. And to look at how that compares to history, I'm going to make it a little bit shorter than this. There we go. Here was the COVID crunch, where our highest VIX that we got to was 85.47. Let's compare that to the crash of 2008. 89.53. So we almost got to the point of volatility that we reached in 2008. So why aren't we in a recession then? Why don't we say that we're in a recession economy? Because remember how I said the market tends to kind of be ahead of the economic cycle? This is a perfect example of that, where the market hit bottom and bounced back up so quickly that the economic cycle didn't even have time to catch up. There is a definition of what a recession is. A recession is 2 quarters, so quarter 1 of 2020, quarter 2 of 2020, of decreased GDP, so how much stuff the US produces goes down for 2 quarters in a row. We didn't have that happen. So we didn't meet the textbook definition of what a recession is. But if you looked at the volatility as a way of saying how volatile was the market, how worried were investors? Well, investors were almost as worried as they were in 2008, which is a very interesting sign. And let's look at what's happened since, where if we track the VIX, it's gone down, 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 spiked, down, 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 where in August, we got back down to about 20, but never really went below 20. And in the last day of August, and by that I literally mean August 31st, the volatility spiked again. And we're now up above 30, in the range of about 30 to 35, which is again over double what we consider to be a stable market. So what does this mean? This means that we can't rely on our standard economic cycle to be our kind of guidelines. We can't expect for the sectors that typically perform well in this type of economy to be our leaders. No. We had that when our sector or when our volatility was going down. But as soon as the volatility shot up, our sectors. Sadly, the one day momentum doesn't seem to be correct at the moment, but if we look at the 1 week momentum, there was a little bit of activity. Mainly, we have technology not doing so hot. That's one of those sectors that, while it's not one of our super volatile sectors, will definitely be affected by a down market. Meanwhile, other sectors, such as utilities, have gone up quite a bit. But again, it's important to look at, is this happening short term or long term? Where we see that technology, yes, it got hit hard, where a lot of its momentum has now reversed to being negative trends. But a lot of our changes, and by a lot, I mean literally all but plus or minus one, has been in the short-term period. So we're seeing short-term signs of volatility, which our VIX is a great indicator of. Whereas the volatility is increased, we've lost our clear market leaders. Where now, if we sort by total, we see that while we have some of our traditionally our sectors that were performing very well in our expansion economy, discretionary and communications, we also have other outliers such as staples doing well, building materials doing well, industrials doing well. But there's no trend. There's no promise of why these sectors are doing well and who will be doing well. And because the market is uncertain, investors don't like uncertainty. That's why the volatility has increased. They're not so sure who's doing well today or who will be doing well tomorrow. So they're going to try and make their profits today. They're going to try and sell high because they're hoping that someone else thinks that what they're about to buy or what that person's trying to sell is going to go up. And that's what's led to this surge in volatility that we see. Beyond that, sadly, I don't know the answer, and I don't even think Warren Buffett may know the answer, where this is now a market that is outside of what we would expect to see. This is now a market that has a lot more risk because there's no certainty. And this is where other indicators like bullish percent can start to be very, very useful, where we see some of the hardest hit sectors are also the sectors that had their BPI be very high. I want to take a look mainly at technology. I want to see what's happened to technology's bullish percent index. So to do that, I'm going to click over here on BPI charts. And then I'm going to scroll down to view the XLK chart, which will then give me the bullish percent for technology. So we see, even when the market was still not doing bad, but when the market started to show signs of increased volatility, we see that there was a reversal that occurred. The bullish percent went up to 74, which is in our overbought range, reversed into a column of O's, and through September has tanked over almost 30% in BPI in less than 2 weeks. So we see how quickly a sector can fall out of favor, and with it, the BPI gets dragged down as well. Let's compare that. I want to compare that to discretionary, because we would expect in a market such as this, where volatility is increased, for discretionary to be following suit. This is one of our glass house sectors. So why is it holding on? Let's go look, shall we? Let's take a look at what our chart looks like here. So we just have a reversal. We just, in the month of September, have reversed into a column of O's. This is not a promise. This is the direction it's going to go. We do not know for sure that it's going to keep going down. But the BPI has now reversed well above that 70% line. So to me, this would be a sign to keep an eye out, because it may continue to go down, just as other opportunities may emerge while some close. Let's look at a sector such as XLU, which had the largest total count change over the past week. Looking at utilities, we have a massive downward column for 2 months, where our downward column puts us now in the 40 or so range. But there's a large change in X count. Why are we not seeing that change here? Because bullish percent, it needs a little bit more gusto than just some bad news. Bullish percent needs market change to actually shift. But when it shifts, it tends to stay in that direction for a very, very long time. Looking through the history of this chart, it's very rare to see bullish percent fluctuate when it gets above its 70% line. We'll oftentimes see massive reversals occur when it gets above 70% and then reverses into O's. Just as we'll see large changes occur when we go down below 30 and take off from there. Adriana is asking a great question. If I invest 2 weeks ago in a leading sector and I'm using the 2-week strategy and I need to see who is the leading sector today, what if I don't see one? Should I leave it where it is? So this is where we get back to what I talked about before, where sometimes the best investment is cash. The 2-week strategies that we showed as part of our case studies or as examples, again, are just examples. We recommend that you create your own way of trading and use them as a guideline, but not as a crutch. But for those strategies, if there is not a sector that meets those 2 requirements, then it would be a sign to sell off and hold cash. And you would hold cash until something meets the requirements. That is actually the reason why, when we showed how our 2-week strategies performed through March, so from the beginning of this year to August, I believe, the best performing strategies, what did they invest in March? They invested in cold hard cash. They did not invest in sectors. They did not invest in anything. They invested in not investing. Then when the market started to show signs of recovery, that's when the strategy bought back in. So there's something to be said for when there is an opportunity to buy, but also when there is no opportunity to buy. Where just because you have something in your portfolio doesn't mean that you're not trading. It means that you're holding something. Not trading would be holding cash. Trading would be holding something. Even if you're not trading it actively, just because it's in your portfolio means that you're trading. You may not be buying and selling, but you're holding. So there's a great opportunity in a market where the best performing market is not being in the market at all. And that's where other investment opportunities exist. And that's something actually the more and more I talk about it, I feel would be a good thing to talk about, which is Sectors Made Simple is a great tool because it helps identify leading markets, but it also helps identify if there is no leader, if there is no clear sign of a sector being strong. And when that's the case, just because sectors may not be strong doesn't mean that bonds aren't. Bonds are a type of investment that offer a fixed risk. They are very, very defined amounts of risk. And when there's more risk, there's more reward. But there's also other options where some government bonds may be maturity rates of 2 years, which means you would get paid back in 2 years plus interest. Well, you're going to get that interest payment. And that's where you would make your money there. But who's to say that that money couldn't be better spent in stocks or something else? So that is where other opportunities may emerge, where it may be bonds or it may be commodities. People always say the gold standard, everything is worth its weight in gold. Why do we compare everything to gold? It's because before we had the stock market, before we had investors, before we had anything, the currency for many, many nations and for many civilizations was gold, was silver, were precious metals that are worth their weight because of what that metal is. The price of gold over time has gone up consistently. It is a very secure investment because of that. That doesn't mean that it's the best investment at all times, but if you were to hold it over the past 2,000 years, because I prefer to look at my 2,000-year trading strategy, it's been a very good long-term trading strategy and a very good long-term commodity. But other commodities exist. So there's a market where commodities could be your best option. There's other markets where your bull market may be in bonds. And it's very tricky to know where that is, because again, if it were that easy, we would have all made millions. But we can take the pieces of information that we do have, and we can say that, maybe commodities would give me 3% month over month. Maybe if I invested in stocks, I could make 5%. But you know what? There's a lot more risk in that 5%, so I would rather take my 3%. Or you could say, I'm going to go buy government bonds that offer a 1% annual interest payment. And that is the biggest danger with bonds or other types of small fixed interest rate securities. Just because you put in $100 and you get $101 out doesn't mean that you would have been better off with that money, because the value of that money has gone down. I talked a little bit about inflation before, where over time, the value of money gets smaller and smaller. I definitely don't remember a time, but there was a time not long ago that you could buy a burger for 5 cents. Gas was measured in cents per gallon, and buying a car for $1,000 meant that you got yourself a Rolls Royce. If I could get a Rolls Royce for $1,000 right now, I'd be a very, very happy Jonathan. I sadly cannot. It's not that easy. But the value of money will change over time. So everything you invest in, there is an opportunity cost associated with it, because that money could have also been put elsewhere. That $100 that you invested into a 1% interest rate bond could have been put into a 3% interest rate commodity, or 5% interest rate ETF if that ETF went up. So that's the real challenge, is opportunity cost. What am I losing out on because I decided to invest in this, or because I decided to hold cash? And this creates a all too real fear or worry for investors. That's called FOMO, fear of missing out. You feel like because I'm staying inside to study right now, that there's a party going on outside and that I feel like I'm missing out on that party. And that's the biggest danger as an investor, is worrying about what else is going on across the street or what else is going on in someone else's home. Worry about your own home, worry about your own investments, and figure out what the best investment is for you. With more risk, there is more reward, but that's where there's different options for sectors. Our defensive sectors will offer that smaller, more consistent option, while our more aggressive or cyclical sectors, while the market is doing well, will offer you much more opportunity for profit. But when the market starts to turn, those are usually the first ones to go. Again, investors are smart. They look for risk versus return. And I would be lying to myself as well as to you if I said that I could tell you what the best risk or return strategy is, because realistically, it depends on you. But there are options. You have so many options, and that's the funnest, but also the most intimidating part. So the goal of BPI is to give you risk. The goal of the economic cycle is to give you the whole picture. So you know the sector's amount of risk, you know the market's amount of risk or the volatility in that market, you know how the economy is doing, if the economy is growing, if it's shrinking, how buying habits are impacting the economy, and how investors are moving the economy in a good direction or trying to pull it out of a bad direction. So that's all I have for you all today. I want to just see if anyone else has any more questions or anything that is unclear or that they would like further explanation on. If I can't answer your question now, I will make sure to answer it at a later point. While we're waiting for questions to come in, Girasoles, I have a piece of information / announcement for all of you. So this marks about 1 month since many of you have joined us. It has been an amazing opportunity to have all of you with us, and sadly, that month is coming to an end. For many of you, the month has already ended, yesterday or today. For many, the month will be ending sometime between now and our next members webinar. But I want to encourage you all to stick around, because as you've hopefully seen, the value of Sectors Made Simple is not just in the matrix. It's in the community and the amount of information around the matrix, and continuing not just to teach you all how to use the matrix better, but me learning and us learning at Sectors Made Simple how we can gain more out of using the matrix. And it does not stop here. This is only the beginning, and this is only the ground floor. So I want to offer you all an opportunity to join us at the ground floor. Right now, Sectors Made Simple is available for $500 a year. This price I want to offer to you all. This is not something I'm going to advertise. This is not something that's going to become a banner on our website. But on September 15th, next Tuesday, the price will go up to $600 a year. If you are a Girasoles member and you want to buy Sectors Made Simple, you have, for the next week, an opportunity to buy Sectors Made Simple at this $500 a year price. This is not an advertisement I'm going to put out there. This is something I'm only telling to you all directly. So you know that you guys mean something to us. It's not just more people in our group. It's more voices in our community. And I would love to be able to keep you all around and to continue learning and teaching alongside you all. So I want to give you guys this last opportunity to buy in at our $500 a year rate, because come September 15th, that rate will go up to $600 and it will never go back down. But if you buy in at $500, that is the price you will always pay. Doesn't matter what features we add. It doesn't matter what happens from here. Sectors Made Simple and these webinars will always be available to you for $500 a year. So I hope all of you can join us. I hope that you have found the value in the information we provide, but also found your voice and found your confidence. If nothing more, and if this is the end of your Sectors Made Simple subscription, I hope you've enjoyed getting to learn and see what we're all about. And I hope even if you don't buy or if you never buy Sectors Made Simple from here on out, that you still join us in our Friday webinars. Those will always be free and available to everybody. The information that we provide here, I would love to be able to offer to as many people as I can. So I will continue trying to do so. And I'll continue trying to make it easier and simpler to gain access to this information for as good of a price as I possibly can. So again, you all have until next Tuesday, September 15th, which is when the price will go up from $500 a month, or $500 a year, my apologies, which is what it's at right now, to $600. And this is not an offer for everybody. This is only an offer for all of the Girasoles who have been with us, who have been with my mom for their 6-week course, and then have been with us for another 4 weeks. I hope you all have enjoyed the learning, but have enjoyed the community that surrounds the investments. Invierte por tu cuenta, pero no solo. No one is alone here. We are all a team working together to figure out how investing can be made easier, more secure, and simpler. So I hope everyone is able to continue us on our journey, because this is only the ground floor. We have many future updates, many future plans, and many future things to share with you all. And I hope everyone can be along with us for that ride. So thank you all so much. It's been such a pleasure. I will see everybody next Tuesday. And for Sectors Made Simple subscribers, next Tuesday, I have a very fun class to share with you all, where we will be going through the matrix, making some trades together, and you get to see exactly how I think and how I use the matrix to make my investments simpler. Thank you all so much for joining us today. Girasoles, thank you for joining us for the past month. I hope many of you can stick around. I hope everyone can stick around for our free webinars, and I'll talk to you all on Friday. Take care, everyone.